Okay, students, Assalamu alaikum, good day. This is your trainer, F7 FR trainer, Mustafa Mirchawala from Mirchawala Hub of Accountancy. The objective of today's class is basically motivation. The first objective is the motivation, okay? Because these are ending days, and normally students are tense in these days. Normally they are tense, they think a lot, or I should say they think a lot of negative things, right? Okay, so I would like to say, be positive in this time. You all have studied a lot. Even if you guys have attended the normal course, so in normal course we have covered, I think, almost everything in extreme depth, right? But if you followed all the instructions given in the class, like when I teach FR, I normally recommend all my students to read Kaplan study text, at least for IS IFRS. Yes, because why do I say this? Why do I say this? Because it is written in the examiner report. I always say you guys that read the examiner report as well. It is written in the examiner report to read the official content providers material. Official content providers material means like BPP, Kaplan, these are official people, official content providers. Okay, so never ever underestimate the book reading thing. But right, okay, if somebody has not read the book, now it's not time to read the book. Sorry, you are late, and don't worry about it. Now it's late. So now it's time to do past papers. It's time to read summaries. It's time to do mock exam. It's time to read examiner report. It's time to read examiner report, right? Okay, so these things you should do at this time, and this time give positive motivation to each other, or you should help each other. If you help each other, your concept will be strong. If somebody is asking a query, you should immediately reply in this way. In this way you can recall your concept, if I see my past position holders, they also followed these things, and that's why they scored positions. Okay, right? So let's hope for the best. Let's hope that you guys also, few in this group right now, we may get some position holders as well. And yes, it is possible ordinary people score position, right? One value added thing which I have launched now in my SBR, because SBR paper is almost 85% theory based. And in F7, yes, the ratio analysis, the interpretation of financial statement part is also theory based. It's majority theory, right? Except for that calculation of ratios, the real thing is theory writing. Okay, so when students write theory, they do some mistakes and they don't get confidence whether they are writing correct or wrong. So in SBR paper, I officially introduce this thing, and I welcome all students to send their scripts to me, and I personally mark them and I give them feedback, detailed feedback, that what are your weaknesses. Okay, so for you guys as well, only my registered students, obviously, you can also send your ratio analysis part, because obviously the other parts are practical one. You can compare it from the solution, you can compare it from the examiner solution. Okay, so this is the email ID, this is the Gmail ID, please write it. Examination, read, you can see, read the spelling as well. Examination scripts, EXAMINATION, scripts, SCRIPTS, scripts @gmail.com. Send your ratio analysis questions here, question as well as solution, so it would be easier for me to check. Question, also attach the question and your solution in Microsoft Word. You can send it through Microsoft Word, because ratio analysis 99% things are theory typing. Okay, so follow it. I'll mark and I'll give you feedback. Please avail this service. This is especially for my registered students. Kindly avail this. And this is the Gmail ID, please write it down. If you send, I will give you feedback. Try to send at least 2-3 questions, so that we'll let you know what's your mistakes are. Okay, and now in today's class, in today's class, we are going to do March June 2021 past paper of F7, which is available on accglobal.com. Obviously, accglobal.com, they don't disclose that they don't disclose the first 60 marks. So last 40 marks are available. Last 40 marks are available. And we can easily solve that last 40 marks, and you will come to know how to do it. Okay. And luckily there is one question of ratio analysis is there. Okay. So you will come to know how to solve it. And yes, the main objective is motivation, because many questions we have already done in the class. The real objective is motivation. Okay. So be connected, stay focused. I would recommend don't use the cell phone during the class, just for today's class at least. Okay, let's move to the question. And yes, I'll show you the question on the screen as well. If you don't have question, you can take the pics, or you can download it from the accglobal.com website. It's available. Okay, because obviously I'll have to move the screen as well. So I would recommend you guys to take the screenshot or take the pic, so that you will have question on the other screen as well. Okay, let's start. This is the question. There are, in the last 40 marks, you will have two questions, 20 marks each. So this first question is purely ratio analysis, that is interpretation of financial statement. Now, what the examiner says, pastry company is considering the acquisition of a subsidiary in catering industry. Now, right, simple case. We are parent company, we are P company. Okay, one more announcement. We are sending a WhatsApp group link in the comment section. All of you guys are requested to join that WhatsApp group. We'll send you the stuff, even these files and many more things after the class as well. Okay, so all of you students, we have sent a WhatsApp group link in the chat box. You all are requested to join. That WhatsApp group. Okay, thank you. Now, what's the story? Pastry company is P company, and P company has a lot of cash. And I always say this in my class, that P company is one of the investor. P company is basically investor. So now let us say P company has extra cash, and now this P company is planning to acquire a new subsidiary company. Okay, so we have two options. The first is Cook company and the second is Duff. Okay, now Cook company and Duff company. So we have to opt one of them. Now, first question, sir, do we have a similar question like this in our exam kit? Yes, in previous past papers and in exam kits, you have seen such questions. This is not a new game. This is not a new question for you, right? Okay, so you have already done such type of questions in your past papers or in your exam kit. And that's the beauty of F7. That's why I say it is easy to clear. F7, because many questions comes from the past paper. They repeat things, but in SBR level, normally examiner, very rare they repeat questions, but in F7, yes, they do repeat. So that's one of the beauty, that you can easily clear this paper, and that's why the passing rate is high. Okay, so now the industry is catering industry. Don't forget, two companies have been identified as potential acquisitions. These two, Cook company and Duff company, and extract from the financial statement of Cook company and Duff company have been reproduced below. Okay, so these are the financial statement. Like income statement and SOFP extract. So first of all, see the year end. What's the year end? The year end is 30th September X7. The year end is 30th September X7. Okay, now you can see you will have revenues, cost of sales, gross profit, operating expenses, finance cost, and that's all. Just a quick short one. You can see the revenue of Cook company is higher and the Duff company is lower. So the first thing which you identified, that the revenue as well as the profit, final profit, the revenue as well as the final profit, both are higher in Cook company. So maybe possible that Cook company believes in quantity sales. Maybe possible that Cook company believes in quantity sales. The absolute number of sales and absolute number of profit is higher in Cook company than Duff company. These are little observations which a normal student can check. In each and every question you can check and you can write. You can check and you can write. And obviously when you are giving paper in the center base, you guys, majority of you are giving in center based. So in center based you will have a paper and pen. You will have a paper and pen. So try to write these small points. These small points you can write. Okay. Now then again, property of Duff company is too much higher, almost three times. It's too much higher. See, you can write this point, okay, right? Then you will have same ordinary share capital both company has, but yes, easy, obvious marks. There is a revaluation reserve here in the financial statement of Duff company. That's why the property is high. So in simple terms, look at here. In simple terms, the Duff company is using revaluation model and Cook company is using cost model. That's why there is no revaluation reserve in the Cook company's SOFP. There is no revaluation reserve in the Cook company SOFP. Yes or no? Okay. So now just simple thing. If you compare directly with Cook and Duff, so they have different accounting policies. One entity is using cost model while the other one is using the revaluation model. So this comparison is not like with like. This comparison is not like with like. Okay. So now, to make comparison like with like, we must do some adjustments. And let's see what examiner says. Now wait, one more thing we can identify: the retained earning of Cook company is higher. The retained earning of Cook company is higher, while the retained earning of Duff company is extremely low. See, it's very low. The retained earning is very low. So overall, if you remove the revaluation reserve, if you remove the revaluation reserve from Duff company's financial statement, please look at the lecture. Ignore the chat box now. Look at me. Please concentrate on the person. If you remove revaluation reserve from Duff company, then Duff company's equity, net assets, Duff company's equity is far lower than Cook company. See, only share capital and retained earning, 1000 plus 2600. See, 1000 plus 2600 makes 3600, and this company 1000 plus 18310 is almost 19,000 something. So if you remove revaluation reserve, surplus or revaluation reserve from Duff company's financial statement, then Duff company has a very low equity, which can be seen. Okay, then you have loan notes, 5200 and 7300. 5200 with Duff company and 7200 with Cook company. Now, can you calculate the interest percentage? That means both entities took loan, and definitely they have interest expense, finance cost. Definitely they have interest expense and finance cost in their financial statement. Have a look. See, Duff company's finance cost is 200. And what is the amount of loan? The amount of loan is 5200. Duff company's finance cost means interest expense is 200, and Duff company's amount of loan is 5200. Can we calculate the interest rate? Yes, we can. Look at here. So in the numerator, you'll write 200. In the denominator, you'll write 5200 times 100. Can anybody of you tell me the interest rate of Duff company? Can anybody of you tell me the interest rate, interest percentage they are paying? 200 divided by 50, 3.85% only. So that means Duff company has obtained loan for 3.8 or 3.85% only. Now let's look at, now let's calculate for Cook company. See, this is the finance cost 650 and this is the loan amount. Cook company finance cost is 650. Cook company's finance cost is 650 and the loan amount is 7300. So let me write here 650 divided by 7300 times 100. It's, I think, 8.9%. Okay. So these are very obvious things. These are very obvious thing, and we are doing latest past papers. Don't forget this. So see, you can see that Duff companies got loan on very low interest rate, and Cook company got loan on very high interest rate. What may be the reason? What may be the reason? What may be the reason for this? What may be the reason for this? The reason for this may be, listen, credit worthiness. Very good, very good. The reason for this, if you have a good credit worthiness, or in other words, we call it low credit risk. If you have a very excellent background, you are very rich and you are very trustworthy, then people may give you the lenders may give you loan at low interest rate. So apparently looks like Duff company's credit worthiness is better than Cook company. Duff company's credit worthiness is better than Cook company. Okay, 1 point. Second thing, there may be a possibility, listen, there may be a possibility that Duff company has given a big guarantee. Duff company has given a big guarantee or collateral guarantee, charges. In F4 paper you have studied charges. Okay, so, and you can see the properties. Duff company's property is already very high valued property. So there may be possible that Duff company has given a big collateral guarantee or charge. That's why the other party is charging only 3.85% interest rate. Okay, so this may be the reason, and these are the obvious scoring points. Yes, these are not the ordinary points, these are the scoring points which you should highlight. Okay, you can also work on gearing, right? Okay, now this was just an overview by looking at the first at the financial statement, by looking at first eye view on the financial statement, right? Now we are moving towards the some of the theoretical points attached. I'm sure you guys can see it. Both companies are owner managed. Yes, you know the owner managed means 100% shares with the owners. 100% shares with the owners, or you can call it unlisted companies, private limited companies. Both are type of private limited companies. Okay, right? That means owners are present in the companies. That means owners itself are directors. Owners, the shareholders are itself are directors. Okay, that means Duff company operates from expensive city center premises. See, Duff companies has very expensive premises, expensive malls and all, selling to local businesses and the public. That means they are doing retail business. Duff company is doing retail business. Okay, Cook company is a large wholesaler. Cook company itself is a wholesaler selling to chains of coffee shops. Cook company operates from a number of low-cost production facilities. See, they are working. Looks like. Listen, they are working on big scale. And I'm sure you all aware of this word, economies of scale. Okay, economies of scale. When you extend your operations, when you work in quantity, your cost goes down. Your cost goes down. The ideal example is bulk discount. The ideal example is bulk discount. The ideal example for this is bulk discount, right? Okay. Yes, one student has raised the point. Yes, Duff company is like branded. They are working from big malls and big premises, so that's why they may charge high prices. Yes, and when we will be discussing, then when we will be discussing the question, we'll raise this point. We'll raise this point. Okay, right? And maybe if the margins of Duff companies are higher, then we can raise this point. Okay, you guys are doing good input. Yes, I can see good inputs you guys are doing, but still, let's see the numbers first. Then we can make the comment. Thank you. So don't forget this point. Each and every point has its own weightage. Now, on 1st October X6, please, this question is not just about interpretation, it's about accounting as well, little bit of accounting, IAS as well. Listen, you remember your accounting period? Your accounting period was ending on 30th September X7. Okay, so definitely it should have started from 1st October X6. Your accounting period is ending on 30th September X7, so it must start from 1st October X6. Okay, now see, we have already seen this. We have already seen this that Duff companies is following revaluation model. Duff company is following revaluation model, but they are giving you exact numbers of revaluation with dates and everything, with policies and everything. There is a message. But to be very honest, you must know basic accounting. You must know little basic things of accounting, IS 16. Okay, Duff company revalued its property for the first time, very first time. Okay, this was the first time, resulting in a gain of 30 million. So at the beginning of the year, there was a 30 million revaluation reserve. 30 million is 30,000. You can see in the SOFP. 30 million is 30,000. You can see in the SOFP. The properties had a remaining life of 30 years on 1st October X6. Now use your brain. Go slow. Just think, whenever we do revaluation on the first day of accounting period, so definitely this year depreciation will be calculated using updated amount. And as we are doing upward revaluation, students, use your brain. As we are doing upward revaluation, so definitely your depreciation expense will go up. Can you tell me how much extra depreciation you booked because of this? How much extra depreciation you booked in this year because of this? 30 million is 30,000. So extra depreciation because of revaluation is 30,000 divided by 30 years, and that is 1,000. Okay, so you must know this thing. That because of this revaluation, you must have booked 1,000 extra depreciation expense in the P&L. Okay, in the income statement. Don't forget this. Easy point, not difficult. Now, Duff company does not make, thank God, easy, thank God. This is a gift from examiner. Does not make a transfer from the revaluation surplus in respect of excess depreciation. I'm sure you are well aware of this policy. You guys are well aware of this policy, that because of excess depreciation, you need to make one entry every year. Sometimes you need to make this entry: debit revaluation reserve and credit retained earning. Debit revaluation reserve and credit retained earning. In my classes, I used to say transfer entry. I used to call this entry as transfer entry, but thank God, they are not requiring any transfer entry from you. They are not asking any transfer entry for you, so ignore it. Now, openly they are saying Cook company uses the cost model to account for its properties. Duff company and Cook company charge all depreciation to operating expenses. See, they don't book depreciation. They don't book depreciation in cost of sale. They are booking depreciation in operating expenses. Don't forget. I'm taking just 30 seconds, 1 minute break. Okay, just I'm here with you. Read it. Okay. Okay. So don't forget this, they book depreciation in operating expenses. That means the depreciation affects the operating expenses. Don't forget this thing. The depreciation affects the operating expenses. Okay. Something we are going to do. And how much extra depreciation Duff company, how much extra depreciation Duff company booked? How much extra depreciation Duff company booked? It's 1000. Okay. Now, the third point, Cook company charges the amortization. Cook company charges the amortization of its research and development to cost of sales, whereas Duff company charges the same cost to operating expenses. See, these are two different policies. Cook company is booking amortization of development cost in cost of sales. So definitely this would affect the GP margin of Cook company. So to think over it, don't sleep, you are no more kids. Within 10 days you have your paper. Okay, so now don't act like a kid. Listen, so Cook company books amortization of development cost in the cost of sales, so their cost of sales will be higher, so their gross profit will be lower. This is the obvious effect. But what Duff company does, Duff company books amortization in operating expenses, so that means their GP won't be affected. Their GP won't be affected because of this amortization. So this is the difference. This is the difference. Again, I would say their books are not comparable. Their books are not comparable. Can you see the amounts? These cost amount to 1.2 million for Cook company. Open your eyes, for Cook company, and 2.5 million. 2.5 million means 2,500 for Duff company. Okay, right? So something we need to correct. We need to correct very soon. So don't sleep. Put things in your memory. You have a memory, or write somewhere. Now, the notes to the financial statement show that Cook company paid its director total salary of 110,000. Cook company is paying 110,000 salaries to directors, whereas Duff company paid its director total salary of 560. I would say this is a scoring point. Lot of discussion we can do on that. The first discussion, I will do a lot of discussion, but the first discussion, listen. The first discussion is Cook companies paying less salaries. Cook companies paying less salaries, so their operating expenses are low. That's why their operating profit will be higher and their operating margins will be higher. This is the first thing. Cook companies paying less salaries, that's why their operating expenses will be lower. Operating profit will be higher, and ultimately the margins and overall performance will be better. Okay, this thing. Second thing, one defect. We don't know who is right. We don't know Cook company is correct, listen to me, or Duff company is correct. We don't know, because average salaries, the market salaries are missing. The market benchmark salaries, the market salaries are missing. This is the defect. The market salaries, we don't know who is right. Maybe Cook company is paying okay and Duff company is paying extra, or maybe Duff company is okay and Cook company is paying lower. So there are both possibilities which we need to discuss. Okay. And now one technical point. This came before 15 years. I saw one past paper, and after that it also came. Listen, as it is written, listen. This is the company, and I am the 100% shareholder plus director. This is the Cook company, and you know, these companies are owner managed. Please study with heart. These companies are owner managed. That means 100% shares are owned by a few persons, like family members. Okay, so we have two options. As an owner, we have two options to extract money. From the company. The first thing, we can extract in the form of salaries. We can as a director, we can extract money from the company in the form of salaries. And the second option, we can extract in the form of dividends. Look at here. So, you know, why Cook company is paying low salary? Why Cook company is paying low salary to director? Director means owners. They are same. Directors means owner, because they intentionally, they may intentionally want to increase the profits. They may intentionally want to increase the profits, because if they withdraw more salaries, salary is an expense. If they withdraw more salaries, salary is an expense. This will going to affect their income statement badly. So that's why there is a possibility they are withdrawing in the form, they are withdrawing funds in the form of dividends. And we all know ordinary dividends are not an expense. Ordinary dividends are not an expense. Yes, one thing, one commentary. Second commentary, please think over it. Think over, these are technical points. You know, Cook company directors are taking less salary because they want to keep money inside the company. Cook company's directors withdrawing less. Look at here. Cook company's directors withdrawing less salaries because they want a lot of money inside the company. They are happy to have more money inside the company. They want to reinvest the funds. And you can see the Cook company's retained earning is higher. Cook company's retained earning is higher. Cook company's return earning is higher. Okay, so it looks like Cook company has more investment opportunities. That's why they want to reinvest in future. But what Duff company is doing? Duff company is taking, the directors are owners. The direct owner managed company means directors are owners. So they are taking big salaries. They are pulling out big salaries. So very less retained earning left. You can see in the balance sheet. I just showed you the SOFP. Very less amount left in the SOFP of retained earning. So it looks like Duff companies owners are not interested to reinvest, or they don't have any good reinvestment opportunities. This may give the sign that they don't have good investment opportunities. Okay, so these all things we can discuss. Even I've told you repeatedly. Okay, so just giving you a minute to think over it. Giving you a minute to think over it. And if you understood this last point number 4, which I discussed, if you understood, kindly hit a message in your chat box. Thank you. Okay, thank you. Stay connected, please don't sleep. Stay connected. It should be a two-way traffic. It should be a two-way traffic. Then you will enjoy. Okay, please. Now, examiner is saying in point number 5, these 3 ratios are ready-made given. That means one thing is mandatory for all of us to discuss these 3. Yes, you can discuss other things as well, but these 3 are now mandatory. To discuss. Okay, GP margin of Cook company is 32.3 and Duff is 48.8. Big difference. But on the contrary, operating margin of Cook company is higher and Duff company is lower. What does it suggest? It suggests that Duff company has high operating expenses. Duff company's cost is not in the control. And yes, Duff company's high operating expenses is linked. Duff company's high operating is linked with the director's salaries. More director salaries, yes. And there is an extra depreciation because of revaluation. There is some extra depreciation because of revaluation. There is some extra 1000. Remember, extra depreciation because of revaluation. Okay. Now then, return on capital employed. Again, Cook company has higher return on capital employed. Duff company has lower. And very simple comment when normally examiner starts with that return on capital employed shows the overall efficiency. Return on capital employed shows the overall efficiency. So apparently, in the first look, Cook Companies is more efficient than Duff Company. But yes, you guys are saying correct. I can see the chat box. This is because of the revaluation policy of Duff Company. Duff Company's ROS is lower. Duff Company's ROS is lower because of revaluation policy of Duff Company. Okay, so these are very easy things. Listen, students, to be very honest and very frank, now nothing to hide. You have seen the course, you know the reality of the paper. These points, if you have done the exam kit, if you have taken classes, you must be aware of at least these sentences, these lines. These are routine business lines. At least these are not new for you. At least that's why students are replying. Just think, that's why some students are constantly replying through chat box. They are participating because they know this is a routine thing. Okay, now read the first requirement. I always say, do big investment in requirement. Requirement can change your score. Reading requirement can change your score. Listen, read it. Adjust the relevant extract. I'll show you the extract. Don't worry. Adjust the relevant extract. I'll show you. From Duff Companies, you need to adjust Duff Companies financial statement to apply the same accounting policies. Look at the wordings. To apply the same accounting policies, not same numbers, not same expenses. Don't do this. Don't try to do the same salaries. Don't try to book the same salaries as Cook Company has. No, they have not asked this. What they are saying, read their statement. You just need to apply the same accounting policy. Nobody is asking you to apply the same accounting numbers to book the same accounting expenses. No, obviously the two companies are different. They have different incomes, they have different expenses, they have different luck. So what does it mean? It means, listen, giving you quick 30-second idea. Cook Company was using cost model. So let's come to the cost model in the books. Let's come to the cost model in the books of Duff Company. Come to the cost model in the end. That means shift Duff Company to cost model. Shift Duff Company books to cost model, the first meaning. And the second meaning, you remember this point number 2. Let me move the screen. You remember this point number 3. Sorry. In point number 3, Cook Company was charging amortization and cost of sales. Cook Company was charging, open your eyes and have a look. Cook Company was charging amortization and cost of sales, but Duff Company was booking in operating expenses. So now shift this amortization of Duff Company. Listen, open your ears, please, students, good boys and girls, please. Shift this amortization of Duff Company from operating expenses to cost of sales. What does it mean? It means reduce the operating expenses of Duff Company by 2,500 and increase the cost of sales by 2,500. That means you shift it. Okay, so just these two adjustments you have to do. Shifting Duff Company's revaluation model to cost model. Easy words, easy thing. Shifting Duff Company's revaluation model to cost model, easy work. The second thing, the amortization booking from operating expenses to cost of sales. Now, as a student, you may ask, sir, what about the difference of director's salary? That's not a policy. That's not accounting policy. That's their management decision. That's nothing about accounting policy. Okay, right? Both of them are booking total salary. See the notes to the they have not discussed where they have booked the salaries. So that means both of them have booked the salaries in operating expenses. So this is not about accounting policy. Okay, there is no difference of accounting policy in this. So just two things I need to adjust. two things I need to adjust, and I will. And special thanks to examiner. They have given you ready-made extracts. You just need to add and less, and that's just do it. Add and less and done. Okay. Did you understand this point, please? Did you get the point? Did you get it? Okay. Please. Still a lot of things are left. Still the whole commentary I will show you. Don't worry. Lot of things. We will do combined effort. We will do, it will be a two-way traffic. Okay. Now, see, this is the part. See, this is the format which was given in the question. This is the format which was given in the question. See, you don't need to change. You don't need to change revenue. There was no problem in the revenue. So same revenue 16,300 will be copy pasted, right? Yes, you should do something in cost of sales. You should increase the cost of sales by 2,500 because and you should decrease the operating expenses by 2,500 because Duff company was booking amortization in operating expenses. Duff company was booking amortization in operating expenses. And now we need to shift from operating expenses to cost of sales. So what we did, we reduce operating expenses by 2,500 and we increase cost of sales by 2,500. Now go slow. One more thing. Because of revaluation model, Duff company books extra depreciation. Duff company books extra depreciation of 1,000 in operating expenses. So we need to remove that also. We need to remove that also to convert it into cost model. Because in cost model, there is no extra revaluation depreciation, right? So I did remove it from operating expenses. Just these two things you need to do in income statement. Now listen, dear students, what was your previous cost of sales? It was 8,350 plus 2,500. 8,350 plus 2,500 is how much? Tell me, please, help me. 10850. Thanks a lot. Now, what is the gross profit? What is the new gross profit? 16,300, 5,450. Thank you. Now, what about this operating expenses? 4,725 less 2,500 less 1,000. 1,225 is your new operating expenses. Now, finance cost stays same, no change in finance cost. Can you tell me the new profit before tax? 4,025. Okay. And now 4,020 or 4,025, please. It's 4,025. Okay. Thank you. No issue. Now, as the examiner is silent about income tax, no change in income tax. How much is the final profit after tax? 3,245. Now, one scoring point. Listen, what was your previous profit after tax? Your previous profit after tax was 2,245. And what's your new profit after tax? It's 3,245. Okay. So it's a jump. It's an increment of 1,000. It's an increment of 1,000 in profit after tax. See, because of these adjustments, there is an increase of 1,000 in profit after tax. Okay. So basic accounting, basic, not even F7 level. When profit after tax goes up, your retained earning also goes up. When profit after tax goes up, your retained earning also goes up. Okay. So I will adjust this 1,000. I will be adjusting this 1,000 in the retained earning, okay, in the SOFP. Now giving you just 30 seconds to have a look. This is easy part. This is, again, I would say, easy part. Revaluation surplus I will remove from SOFP. Dear, revaluation surplus I will remove from SOFP. Don't worry, because in this question, no OCI part is given. No OCI is given. You can see the question. Okay, now I'm moving. Okay, you don't need to copy it. Don't need to copy it. I'll share the slides with you. Don't worry. Now let's move to the SOFP. In the SOFP, yes, the property was revalued. Asset side, the property was revalued upward by 30,000. Okay, the property was revalued upward by 30,000. You need to convert into cost model. So what you will do, first you will subtract 30,000 and then you will add 1,000, because obviously, just use your brain. First, what you did originally, first you revalued it by 30 and then you depreciated it by 1,000. So you know what is the net impact? The net impact on the property is 29,000. The net impact on the property is 29,000. So now you need to remove 29,000 from the property, and that's what I just did. Now you just need to remove 29,000 from property side, from property asset side, and that's what I did. So how much is this? 39,500. Okay, so after adjustments it's 39,500, the asset side. Okay, equity shares, there is no adjustment, so it stays same. Revaluation surplus, yes, remove it. Revaluation surplus, just remove it. It will be 0, because in cost model you can't put revaluation reserve. Yes, retained earning you need to increase by 1,000. Retained earning you need to increase by 1,000, because I just told you the effect of profit after tax. So it will be 3,600. Your loan stays same, 5,200. Okay, so finally you made the extract, the revised extracts you made. Okay, go slow. Yes, property. Listen, we have to convert revaluation model to cost model. Okay, now I'm repeating. You convert revaluation model to cost model. So whatever you done in doing revaluation, whatever revaluation related things you did with Duff company, you need to reverse it. So first you revalued the property at the beginning of the year by 30,000, one effect upward, and then you decrease the property by 1,000 because of depreciation. So two things you did with the property. That is what the first thing is, plus 30,000, that is upward revaluation, and then minus 1,000, that is depreciation. So plus 30 minus 1, plus 30 and minus 1, net impact on the asset side you took was 29. So now you need to remove. Just see this. Now you need to remove 29,000 from the property asset side. Okay. Okay, now let's read the requirement. Wait, let's read the requirement. Adjust the relevant extract from Duff company's financial statement to apply the same accounting policies as Cook company. And one more thing, we just did half work. We got 3 marks right now. 3 more marks we have to take, or 2 more marks, and recalculate Duff company's ratios provided in note 5. See, these 3 ratios we need to compute again. Okay, let's compute it. Not a big deal at all. Very easy. GP margin, GP upon sales into 100. Operating margin is operating profit upon sales into 100. Okay, operating profit is PBIT. Okay, operating profit is PBIT, right? Okay, so let's start. Now, what's your new GP? Your new GP is 5450. Your new GP is 5450 and your new sales is 16,300. 5450 and 16,300. Okay. Look at here. Look at here. All irrelevant work I have done for you ready-made. All irrelevant work which is not a value-added work I have done already. Okay. See, I have copied the cook companies. I have copied the cook companies. I have copied the cook companies already given ratios in the question. Also, I have copied the Duff companies existing ratios. Now, the next thing we need to do is workings. Okay. So it will be, sorry. It will be 5450 divided by 16,300 times 100. Okay. So it will be how much? It will be how much? Tell me. Okay, thank you. Now, the second is operating margin. Operating margin. What is the formula? Operating profit, which is PBIT divided by sales into 100. PBIT divided by sales into 100. Let's go to the question. You know, this is PBT. Students, this is your PBT. Okay. So if you want to go to PBIT, one step upward. If you want to go to PBIT, you need to add 200. You need to add finance cost in PBT. You need to add finance cost in PBT. So it makes 4025 plus 200. 4025 plus 200 is 4225. 4225. Okay, look at the screen. So it will be 4225 divided by 16,300 times 100. It's going to be 25.9%. Okay. So these things are getting changed. Okay. Now the final is return on capital employed. Final is return on capital employed. You all know the formula. Return on capital employed is PBIT. Return on capital employed is PBIT, which is same 4225. PBIT 4225 divided by capital employed. You know, capital employed is equity plus debt, equity plus loan. You know the meaning of net assets. So you know the meaning of capital employed is equity plus loan. So guys, please go to the balance sheet. This is the balance sheet. What's your equity plus loan? Can you see? Listen, this is your equity. This is your equity and this is your loan. This is your equity and this is your loan. This is your equity and this is your loan. This is your equity and this is your loan. Okay. Now tell me, what is the total? 4,600 is your equity and 5,200 is your loan. 4,600 is your equity and 5,200 is the loan. Okay. So simply plus 5,200, see equity plus loan times 100. Can you tell me what's the number is? It's 43.11%. 43.1%. See, the results are almost changed. The results, we scored the first 6 marks. We scored the first 6 marks. Okay, finally. Okay. And just keep a room. If you go to exam, you go with tension. You go with time limits. Definitely, you never know which sort of paper you will get. Maybe you stuck in first 60 marks and you have less time left for ratios. So just think, in exam conditions are quite different from this class. Okay. Right now you are with your teacher. Just think. So this is natural that in exams you do mistake. This is natural. In exam, you do mistake. Yes, capital employed is equity plus loan, please. Capital employed is equity plus loan. And if you don't know this, I have uploaded a basic lectures of ratios in my YouTube channel, is already there. Basic lecture of ratio analysis is also there. I have uploaded on YouTube for everybody. You can see it's in English language, right? So these are the scores. Now wait, just think, if you compare, now listen these words so that you will be able to understand the commentary as well. If you compare the, now I forgot the name of that question of your kid. In my lectures, I teach that lecture for on the first priority, and this is like in that question you need to calculate the adjusted ratio. Yes, expand. Yes, very good, very good. Expand. There is a question in the exam kit, expand of takeover ratios and ratio analysis, question of takeover expand, in which students, you are given existing ratios and then the revised ratios. So after the revision of ratios, the picture is changed. After the revision of ratios, the picture is totally changed. So this question is like that. This question is like that, little bit like that. Okay, now see the screen. What's the GP margin of Cook Company? 32.3 and Duff Company is 48.8. So apparently in the first look, it looks like that Duff Company is highly profitable. Duff Company is selling products on a very high prices. See, there is a material difference. But when we adjust the numbers, we came to know that, see, now 30, see this, now 32.3 and 33.4. Not a major difference. Still Duff Company's margin is slightly up. Still Duff Company's margin is slightly up, but not that much difference. So the major reason for that, the major reason for the bigger difference was the policy of amortization, because Duff Company was booking amortization in operating expenses, not cost of sales. So the moment we adjusted it, we got the reality. Okay, but yes, still there is GP margin is still higher of Duff Company. This may be one more thing I told you. If you want to write the commentary of ratio analysis, always use the word maybe, can be, because you don't know the reality of company. You are not sitting with the high-end directors of the company. You don't have internal secrets or internal news of the company. You don't sit in the board of company. Okay, you are not even a trainee now. You are not a trainee, internee, sorry. So dear students, that's why it's better to use the word maybe, can be, could be, like that. Okay, so students, this is the first thing you can write. Yes, so Duff Company's margin is still higher, and you know, when GP margin is higher, it looks like we are charging more prices. It looks like we are charging higher prices. So yes, in the first paragraph, you read it that we have higher level properties. We have expensive premises like malls. We have shops in malls and high-end places. So because of that high-end places, we can charge a little higher prices. That's maybe the case. Okay, you got it. Then come to operating profit margin. See, these are all routine commentaries. Then come to operating profit margin. Apparently operating profit margin of Cook Company was higher than Duff Company. So it looks like, what does it mean? What is the basic interpretation of this first two columns? That means the cost control. Of Cook Company is better than Duff Company. That means the cost control of Cook Company is better than Duff Company. The cost control of Cook Company is better than Duff Company. Okay, right? But when we adjusted, when we did the adjustment, see, the picture is again changed. Now the operating margin of Duff company is higher. Now the operating margin of Duff company is higher. Operating margin of Duff company is higher. Okay. What is the major reason? The depreciation thing. The depreciation of 1000 we removed. The major issue was revaluation. The major issue was revaluation, and the revaluation impacted the income statement through depreciation. So when we removed the depreciation, we found something different. Now, in the meantime, with operating expenses, operating profit has got linked. Please look at here. Operating profit has a great link with operating expenses. So when you are coming to operating expenses, now it's the right time to discuss about the salaries of directors. I have already covered, I did a good discussion for director salary in between. If you remember that directors salaries are less in Cook company's book and are more in Duff company's book. Okay, so you need to find out the reasons. I told you some reasons of reinvestment and all. I already told you the reasons of reinvestment and all. Okay, that Cook company may be withdrawing less salaries, that's why they have high retained earning. Cook company withdrawing less salaries because these owners and directors think that there are still opportunities to reinvest. There are still opportunities to reinvest. So don't take out all money in the form of salary. Let the money stay in the company. Okay, so this is the one strategy. And what about the second one? Duff companies is withdrawing a lot of salaries. The Duff companies owners are withdrawing high amount of salaries. That's why their retained earning, ultimately their retained earning is low. That's why ultimately their retained earning is low. Yes or no? So that means they are not leaving any funds inside the company. They are not leaving any funds inside the company because they really don't want to reinvest. Or we can say they don't have any good reinvestment opportunities. They don't have any good reinvestment opportunities. Okay, one point we can also add that we don't have any market salaries. We don't have any market salaries. Okay, average salaries of the market, the benchmark salaries. So we can't say that whether the Cook company is giving less salaries to directors or Duff company is giving more salaries to directors. Okay, because this thing is absent. This average salaries or market salaries are absent. Average or market salaries are absent from the data. Okay, there are weakness in data as well. Then, my dear students, you can discuss that interest rate point. You remember I highlighted one issue. You remember, let me move the screen for you guys. Let me see the screen. See, Duff company got interest rate, finance cost, interest rate 3.85%. Duff company took the loan on 3.85%, and that Cook company got the loan for 8.9%. 8.9%. Okay, so again that credit worthiness point, risk point, guarantee point, which I told you, credit worthiness point, risk point, and the guarantee and collateral point. I am repeating again and again. I have discussed already this thing. Okay, so these points you can also discuss. Okay, now first read the requirement. See, this is 14 marks requirement. Not a joke. Based on these adjusted accounting ratios, compare the performance of two companies. Okay, your answer should comment on the difficulties, yes, of making a purchase decision based solely on the extracts of financial statement. Remember, in my classes and even in the exam kit, I used to discuss this requirement as well. What other data we need? What data we need to make a good decision of takeover, to make a good decision of takeover, good decision of takeover, good decision of takeover. There are many points for this. There are many points for this. There are many points for this. Okay, to for the good decision. I'll guide you in even listen based solely on the listen. Try to give points, some points connected to the question. Try to write some points connected to the question. Okay, right, relevant as well. Now whatever I just discussed, let me walk through with you. Let me walk through those points with you. Yes, very good points, very good points. I'm going to also discuss. Students are raising good points for the deficiency part, what extra information we need. Students are contributing good. Thank you. Now listen, let me walk through the commentary with you so that whatever I just delivered in the lecture, you will come to know. You will come to know. Very good, very good. Some students are raising very relevant points. See, the first thing, remember when I started the question, with you, I just first looked the financial numbers, the absolute numbers. Remember the absolute sales and profit of Cook Company was higher. Remember the absolute sales and profit of Cook Company was higher. See, the absolute sales and profit of Cook Company is slightly larger than Duff Company, but the margins, see this, but the margins of Duff Company are higher than Cook Company. If you just see the apparent numbers, GP margin of Duff Company was far higher than Cook Company. I'm just discussing the initial part. Okay, now please. Then what is written, which means Duff Company is more profitable than Cook Company because of retail business. Yes, because in retail business you can charge high profit. In wholesale business, normally we charge low profits. Okay, right? So apparently in the first look, Duff Company's GP margin was around 48.8% something, and Cook Company's margin was in 30% GP margin. So this was the first look. But after adjustment, see this point, after adjustment, it is clear that these higher margins were because of accounting policy of charging amortization in operating expenses. Remember, Duff Company was charging amortization in operating expenses. That's why their GP margin was so high. But as we just adjusted it, we found a different picture. Then the moment we just adjusted it, we found a totally different picture. We found a totally different picture. Okay, right? The adjusted margins of two companies are quite close. Yes, both are in one is 32 and the second is 33. Okay, we have just seen this, nothing difficult. Now one very relevant point which I discussed there, but still Duff Company's margin are higher than Cook Company. This may be because of Duff Company may be able to charge high prices. You know, when the prices are high, selling prices are high, your margin, because of expensive premises, because of expensive high-end premises. Okay, so this is the apparently this is the first discussion students on GP margin, and this is general discussion, easy discussion. Now next, let's discuss on operating margin. Apparently means at the first look, operating margins of Cook Company was higher. We just saw first two columns was higher than Duff Company. This may be because of good cost control. Yes, if you have a good cost control, your operating expenses are low, so your operating profits may go up, and so your operating margins. But after adjustment, Duff Company has higher margins. Okay, now you know this operating expenses is a very detailed area. There are many things comes under operating expenses. If you go to see the income statement, they have just given one line for operating expenses. Just there are many things comes under operating expenses. So there is no breakup is given. No breakup is given. No breakup is given. No breakup is given. Students, no breakup is given, right? No breakup is given, so you need to criticize as less details of operating expenses are given. So that's why we can't tell the exact situation. We can't tell the exact situation. Okay, now next, one important point. Now this is the right time to discuss director salary. This is the scoring point. Listen, I discuss each and everything of this when I was reading the question. Okay, one important point here is director salaries. One important point here is director salaries. Cook companies directors withdrawing low salaries, maybe, see the first point, because they want to shoot profits. Because the companies are owner managed, because they don't want to withdraw in the form of salaries. Just think, if owners withdraws salaries, so salary is an expense, so expense hits the income statement adversely. So it's better to take out money, to pull out money as a shareholder in the form of dividends, because ordinary dividend is not an expense at all. Okay, so this is also a technique. Maybe they are planning this thing. Maybe the cook company guys planning, owners planning this thing. Okay, on the other hand, look at the screen. Duff company's director are withdrawing more salaries, which is an indication, yes, I just discussed, that they don't want to leave much funds in the company for future reinvestment, which indicates less business opportunity for them. This can also be seen from their low retained earning. Yes, they have low retained earning because they don't leave anything and they take things at home. Okay, so that's why they are giving low dividends. That's why they are taking out more salaries and leaving less amount in the company. Now, one very interesting point. This is also a valid point. Just think, Duff company is booking very high salaries in the income statement. If Cook company books the same salaries, just imagine, it's a what if point. If Cook company books the same salary expense, so Cook company profit will be very low, operating margins will be very low. Just think over it. If Cook company pays the same salary like Duff company, then their operating margin would be lower. Okay, then next, interest rate. Duff company's interest rate is much lower than Cook company's interest rate. I just calculated in using the income statement. I calculated these interest rate using the income statement. Even you can do one more thing. You can write, listen, you can write here in the bracket, Duff companies was, I think, 3.89 or something percent, right? And Cook company's interest rate you can write here. Okay, in the bracket. This is also the best practice of examiner. Examiner also write things in bracket. This is also valuable. Otherwise, if you write without that, still it is acceptable. It's a valid point. Okay, this may be because of good credit worthiness of Duff company, or Duff company has provided certain guarantees to lender of the loan. Okay, so if you provide good guarantees, then you can get interest rate, low interest rate. Okay, then you can get loan on low interest rates. Yes, director salary is treated in PNL. Yes, one guy is asking. Yes, dear student. Now, rows. Initially, wait, let me show you the rows first. See, initially the rows of Cook company is more than double of Duff company. Can you see? Initially the rows of Cook company Initially, the rows of Cook company is almost double of, initially the rows of Cook company is almost double of Duff company. So you will simply define that rows shows the efficiency. So apparently in the first look, apparently Cook company looks more efficient than Duff company. But you know, after adjusting the books, we got the real picture. And what was the real picture? The real picture was that the revaluation model, the difference was revaluation model. See, we have seen a big change. We have seen a big change of efficiency. We have seen the big change in efficiency. Okay, right? Just see these numbers. I'm going to discuss something. See these numbers. One more number you can see. One more number. I'm going to discuss this. Listen. Operating margin of Cook company and Duff company's revised operating margin, not much different. 23.3 and 25.9, very close, very close. The operating margin of Cook company and the revised operating margin of Duff company, revised operating margin of Duff company are very, very close, are very, very close. Okay. Now, and one more thing, see the net assets. The net assets now is only 4,600. The net asset now, the equity is only 4,600 after the revision, because when you remove the revaluation surplus, your net assets of Duff company is very low, very low. Okay. Let's move to the rows thing. See, initially Cook company rows was higher than Duff company, reflecting, listen, reflecting high efficiency of Cook company. But after adjustment, it was clear that Duff company's rows was lower just because of the revaluation model. You simply treated it. Now, in reality, Duff company's rows is double of Cook company, almost double or more than double of Cook company. Okay. Now, in my classes, in your exam kit, in your past paper solutions, you have seen in the initial training lectures, you know, rows is the product of two things. Always teachers teach this. Rows is the product of, whenever you need to discuss in simple terms, rows is the product of two things: asset turnover and operating margin. Rows is the product of two things: asset turnover and operating margin. Okay. So now just relax and look at here. You know, the operating margin of both entities are almost similar. I just proved the operating margin of Cook company and Duff company revised. The Cook company and Duff company revised is almost same. One is 23.3 and other is 25.9. So very close. So operating margins are very close. So you know what thing makes the difference? This asset turnover. This obviously the asset turnover of Duff company must be higher. Just use your brain. My dear student, the revised rows of Duff company is double. The revised rows of Duff company is almost double of Cook company. So now let's compare rows. This is the formula. Either the operating margins are higher or asset turnover is higher. Okay. So operating margin is same, almost same. Operating margin of both entities are almost same. So the thing which is creating difference is asset turnover. So we can say the asset turnover of Duff company is very high, very high. Why? Wait, you know the formula of asset turnover. Let me show you. Wait. The formula of asset turnover is, let me remind you, is equal to sales divided by capital employed. Sales divided by capital employed. Now more dig down. Listen, asset turnover is sales upon capital employed. So either your sales is high, you know, your asset turnover, the asset turnover of Duff company is higher. Either the sales is higher or the capital employed is lower. Either your sales is higher or capital employed is lower. Sales is not higher. Initially we compared the question to income statement. The sales of Duff company was lower. The sales of Duff company was lower, but still the asset turnover is high. What is that thing? That is low net assets. That is low net assets or low equity balance. Because when you remove revaluation surplus from the denominator, from the net assets, so very less equity is left. And we already know Duff company had already very low retained earning. Duff company already had very low retained earning. That's why their net assets are lower. And when their net assets are lower, their asset turnover is higher. Their asset turnover is higher. This is the reason. This is the reason. Now go slow. Read it, please read it. Also, ROS is the product of asset turnover and operating margin. As the operating margin, please don't just read, think over it. Also think over it. As the operating margin of both companies are almost equal, that's why the major reason of high ROS of Duff company is high asset turnover. And the reason of high asset turnover is not high sales. The reason of high asset turnover is not high sales. It's because their net asset equity balance is low. This is what I just proved. This is what I just proved. This is what I just proved. Did you understand, guys? Students, did you understand? Please. Did you understand? Please reply. Now, in the question, if you read the question properly, they ask for the difficulties. So I have made some brief points. For difficulties, not detailed points, but quickly because we have almost invested 1.5 hours on just first question. Listen, because I know students find ratio analysis difficult. That's why I'm repeating things. Listen, these are the problems which you can see. The first thing, in real life, when you do takeover, you ask the fair value, the market value of the company. You ask the fair value, the market value of the company, the fair value and the market value of the company's company's assets. But in this question, the market values are not given. The exact market values of both companies are not given. So this is one deficiency in information. This is a big deficiency in information, because we are going to pay for these companies. So at least we should know what are the market values of the assets. Okay. The second deficiency, only 1 year financial statement is available. Only 1 year financial statement is available. Only 1 year financial statement is available. If you know 1 year financial statement may be cooked. 1 year financial statement may be cooked. So if you see 3-4 years result, if you see 2-3 years result, you can see the trend. You can see the trend, whether it is upward trend or downward trend, whether it is upward trend or downward trend. Okay. Now, third thing, market salaries of directors not available. Yes, I discussed this point. Market salaries are not available, so we don't know who is culprit. Cook companies paying less salaries, or Duff companies are saying more salaries. Okay. Now, risk of companies not given, like sometimes companies are employees dependent. Yes, it happens. You have seen these points, that there are certain companies which are extremely dependent on employees, or there are some companies, those who have extremely related party family related party transactions in them. So that's also a risky thing. No accounting policies given for revenue recognition. No accounting policies given for revenue recognition. Sometimes they book artificially overstated revenues. So this may be misleading for us. One more thing I would like to say, the asking price. What is the price? The asking price is not given. You are going to buy certain things and you don't know the price. How will you buy? You are going to buy certain things and you don't know the price. How will you buy that thing? Okay, so these are more than enough. Examiner has written max 3 points. These 5 points or 6 points are more than enough. Okay, then finally you have to write the conclusion. In the conclusion, you need to write about your risk appetite. About the risk appetite, sometimes this is the policy of parent company to buy high risk entities. Sometimes we buy low risk entity. So buying cook company or that Duff company is, again, we need to, before buying, we need to check our risk appetite. We need to check whether we are happy with the wholesale business or the retail business. I have seen in my country, I have seen my friends, they don't like, some people don't like retail business. Retail business is very is a big headache. Dealing with individual one customer is a big headache. And in wholesale, you sell in quantity. You have just five big customers and you sell in one shot. So less headache in wholesale business. Okay, these are the realities. Okay, so accordingly you need to write the conclusion. I hope you understood maximum points. I never say, student, listen to me. In each and every lecture of revision days and even the SBR classes, I said this openly. Don't go for perfection. Write somewhere. Go for maximization. Okay, no need to be a perfect. You will do mistake in exams. You will do. Even I today, I don't want to take the name. One of my very high position holder student today asked a foolish question from me. In previous attempts, he broke all the record. And today he asked a very simple, foolish question from me. I was laughing. See, this also happens. This also happens. Okay. So accept the reality, the practicality of life. Okay. Now we have to move to our second question. And before we moving, we are just relaxing for 2 minutes because I was constantly speaking. I'm going to pause the recording. Remind me, I have to start recording again. Okay. Okay. Let's start the consolidation part. Okay. First of all, I would like to tell you, I will try to do as much spoon feeding as I can, but still you must know the basic rules of consolidation. Okay. Otherwise it will also take same 1.5 hours like the time we spent in ratios. But still, consolidation basic rules, and this is not a difficult consolidation question, easy consolidation question. Okay, now let's start. On 1st of January X2, Gold Company acquired 90% of the 16 million equity shares of Silver Company. What does it mean? That means S Company, the Silver Company's S Company, has already issued 16 million. S Company has already issued 16 million. S Company has already issued 16,000 shares. Okay. And parent company acquired 90% from them. Parent company acquired 90% shares. Okay. Now quickly you can do it. 16,000 times 19% is 14,400. Excellent. 16,000 times 90% is 14,400 shares bought by parent company, and that means NCI has 10% shares, which is 1,600 shares. NCI has 10%, which is 1,600 shares of S Company. Okay, right? This is the deal. Now let's see what is the consideration. Gold Company, which is parent company. Now wait, one very important thing. This is the takeover date. All of you, I always say in this class, Always highlight the takeover date. This is 1st January X2, and what is the year end? 30th September X2. So it's like part year acquisition. See the gap between acquisition date. These are the first things which you need to highlight. Listen, students, you guys do some mistakes. That's why students got failed. Takeover date is 1st January X2. Takeover date is 1st of January X2, and your year end is 30th September X2. So exactly 9 months gap, 9 months. So, you know, for income statement, you need to apportion subsidiary company income statement by 9 upon 12. You need to apportion subsidiary company income statement by 9 upon 12. Subsidiary company income statement by 9 upon 12. Okay, right? Now, next. What is the deal? Gold company issued 3 new shares in exchange for every 5 shares it acquired in silver company. What is the deal? For every 5 shares, see, 5 shares are coming, 5 shares from S company, 5 shares from S company. For every 5 shares, we'll give 3 shares of P company. Okay. So what, with simple terms, whatever coming from them, right in the denominator, and whatever we are giving right in the numerator, it's the fractions 3 upon 5. 3 upon 5. 3 upon 5 is the fraction. 3 upon 5 is the fraction. Okay. So we bought 14,400 shares. See this consideration. Listen, shares consideration, very easy. We bought how many shares? 16,000 times 90% was 14,400 into 3 divided by 5. 3 upon 5 is the fraction. So how much is this? 14,400 times 3 upon 5 is, can you tell me? 14,400 times 3 upon 5 is how much? 8640. That means we have given 8640 shares. We have given 8640 shares as a consideration. We have given 8640 shares as a consideration, or you call it, we have given 8640 chocolates. We have given 8640 chocolates as a consideration. And what is the fair value of our one chocolate? Our one chocolate cost $8. See the screen. Our one chocolate cost $8. So if you multiply this by $8, you will get the value of shares consideration. You will get the value of shares. This is 69120. This is 69120. 69120. Sorry, 210. 69210. Sorry, 69210. This is your shares consideration. 69210. This is your shares consideration. Students, please try to understand. These are basic stuff you have done many times in the initial lecture and afterwards. So there is nothing to worry about now. You are too late. If you have still problems in these basic stuff, in these shares consideration, and all these are totally basic stuff, please. It's 120. Sorry, 69120. Sorry again. Okay. Now, one more consideration we are giving. And read the dates very carefully. See, additionally, gold company will pay. That means promise to pay in future. Further consideration at 31st December X2, just after 1 year. See, exactly 1 year gap. We took over on 1st January X2, and now we promised to pay them on 31st December X2. So exactly 12 months, 1 year gap. Exactly 12 months or a 1 year gap. So this is called deferred consideration. Deferred consideration is basically unconditional promise to pay cash. Unconditional promise to pay cash. Okay. How much cash? Of 2.42 per share acquired. Per share we acquired. So remember, in the beginning I told you we acquired 14,400 shares. In the beginning I told you we acquired 14,400 shares. 14,400 shares we acquired. Okay, right? So 14,400 times 2.42. 14,400 times 2.42. Go slow. 14,400 times 2.42. This is 34848. 34848. Wait. Let me make a sketch for you. Easy sketch. This is what 1st January X2. Listen. And this is 31st December X2. Okay. So how much you have to pay? 11,400, sorry, 14,400 times 2.42. 14,400 times 2.42. What is the amount? Tell me the original amount. Three four eight four. Sorry, 34. Again, right? 34. 34848. Thank you. After 1 year, 34848 you need to pay. Okay. And now, you know, all liabilities which are payable 1 year or after, you need to discount. All liabilities which are payable 1 year or after, you need to discount. So I think the discount factor is given 0.909. 0.909 student is your discount factor. 0.909 is your discount factor, okay? So how to calculate present value? Simply, present value will be 34848 times 0.9091. This will be 31680. The present value will be 31680. I'm just recalling the entry to you guys. I'm just recalling the entries to you guys. And the entry is investment debit and deferred consideration credit. Investment debit and deferred consideration credit. Investment debit and deferred consideration credit. Got it? So there are two COIs in this question. One is this 31680 and the other one is this shares consideration. First go slow. First break, apply brakes. The first is shares consideration and second is deferred consideration. If you add these two, this will become, your COI, cost of investment. Okay. Now, one more thing you need to do, and that is unwinding of discount. One more thing you need to do, and that is unwinding of discount. But listen, read the year end. See, where is your year end? Your year end is 30th September X2. Your year end is 30th September X2. Okay. Listen. Your year end is 30th September X2. So only 9 months. See, only 9 months you need to do unwinding. You need to calculate only 9 months unwinding. You need to apportion the interest here. So how you will calculate the unwinding of discount? How you will calculate the unwinding of discount of deferred consideration? This is 31680 times what is the interest rate? The interest rate is 10%. 10% into 9 upon 12. How much is this? 2376. Let me write the treatment. Added in finance cost. Even I taught this in my routine classes as well. Can anybody tell me what should be the treatment? Please involve. What should be the treatment of this unwinding of discount in the consolidated income statement? What should be the treatment of this unwinding of discount? No, for the consolidated income statement. I'm asking for income statement, not SOFP. Please don't write CR. Income statement. What is the treatment? All of you, please write. Even I have written on the screen. Innocent people. Yes, it will be added in finance cost. Why? Let me give you logics. Listen. Deferred consideration is basically a promise made by parent company to the shareholders of S company. Deferred consideration is basically a promise made by parent company to the shareholders of S company. So basically, it's a loan on P company. And P company has not already booked this loan. P company has not already booked this loan in the question. When P company has not booked the loan, that means P company has not booked the interest expense as well. So that means the finance cost of P company is understated. So now when you book the loan, When you book the loan, you need to book the interest expense as well. So now obviously when you book the interest expense, the finance cost will go up. So this 2376 will be added in consolidated finance cost. This 2376 will be added in consolidated finance cost. One more very good question. Listen. Will this 2376 affect the NCI? No. Will this 2376 affect the NCI working? No, because this is the expense of parent company, not S company. This is the expense of parent company, not S company. Okay. Now, one more thing, please. Shares in gold company and silver companies had fair value. The share price of parent company is $8 and subsidiary companies $3.5 respectively. I have a question, students. Why they have given the share price of subsidiary company? Why they have given the share price of subsidiary company? Can anybody guide me? Yes, to calculate the fair value of NCI. To calculate the fair value of NCI, sometimes they ask you to calculate fair value of NCI through the share price. Because in the question they are also asking goodwill. Very good. Clapping for those who gave the correct answers. Yes, good. Can anybody, come on, giving you 30 seconds. Can anybody of you calculate the fair value of NCI for me? Can anybody of you calculate the fair value of NCI at acquisition for me? Fair value of NCI at acquisition for me. Yes, you can. Yes, you can. You know, NCI means these 1600 shares. Just see the screen. S company issued total 16,000 shares out of 10% shares with NCI. Out of 10% shares with NCI. So 16,000 times 10%. 16,000 times 10% is 1600 shares. 16,000 times 10% is 1600 shares. Okay. So NCI means 1600 shares times the fair value is 3.5. The share price of S company is 3.5. So 1600 times 3.5, 5600. Very good. Very good. 5600 is the fair value of NCI. Excellent. Now, next thing. Now you have two companies complete full year income statement. You have two companies full year income statement. Just for your help, you can see there is an investment income. There is investment income in parent companies. Open your eyes. There is investment income in parent companies income statement. Wait, somebody is asking a question. Yes, because we paid 2.42 per share. Because we paid 2.42 per share and we acquired 14,400 shares. What you are saying, 8640? Where is the 8640? No, please. You are going wrong. The one who is asking about the deferred consideration is taking the question totally wrong. Totally wrong, please. We acquired 14,400 shares, and for the shares we acquired, we have to pay. It is written. See, per share acquired. It is written. Now listen. Read the adjustment. Now read the requirement first. Let's read the requirement. Calculate the goodwill arising on the acquisition of silver company. So for goodwill, we need COI. We have already calculated. We need fair value of NCI at acquisition. We also calculated. One more thing we need, and that is less fair value of net asset at acquisition date. Less fair value of net asset of S company at acquisition date. But don't forget, your acquisition date is almost the mid-year or part year. Your acquisition date is 1st January X2. Your acquisition date is 1st January X2. So in shortcut, in short, you need to apportion, 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 okay, right? You need to apportion the profits in order to get the correct net assets packet. I'm sure you know that. Okay, so I would love to work out with you guys. I would love if you help me, if you cooperate with me. In this way, you will learn, because you have to give paper, okay? I have given papers years back. Now, on 1st of October X1, the retained earning of silver company were 56 million. Now, see the date, 1st October X1, just before 3 months of the takeover date. 1st October X1 means before 3 months of the acquisition date. Can anybody tell me why they have given this? Because we need to calculate the net asset packet. Because we need to calculate the net asset packet, net asset packet. Let me tell you, my dear, my innocent students, wait. Let me make, those who love spoon feeding, let me make. See, this is 1st October X1. This is 30th September X2. Listen, S company's retained earning A here is 56 million, means 56,000. And you know the takeover date is 1st of January X2. Okay. Now, can anybody tell me S company's profit after tax? What is the S company's profit after tax? S company profit after tax was for the whole year is 9920. Thank you. For the whole year is 9920. Can you do it 3 upon 12? Can you do 3 upon 12 with them? 9920 into 3 upon 12 is how much? 9920 into 3 upon 12 is 2480. Thank you. So you just got the first 3 months profits. You just got the first 3 months profit. So opening retained earning is 56,000 and you are walking forward. You are walking forward. So 56,000 plus 2480, you will have, see, this is your acquisition date net asset packet, acquisition date. Remember, you will have a retained earning of 56,000 plus 2480, 58480. Student, you must know this thing now as you are going for the paper. Okay. Can anybody tell me the ordinary share capital? I think that remains same. Ordinary share capital is 16,000. Just pick from the question. So you got the packet, you got the acquisition date packet. I know the fair value adjustment is missing. I know we need to do fair value adjustment. I know it. Don't worry about it. Don't worry about it. I'll do it. So you just calculated the net assets packet. Yes, it's opening retained earning. Okay. Now, this work I have already done for you. Okay. Now, let's start the fair value adjustment. These are the cash marks. These are the gifts. These are the gifts for these from the examiner. And those who can't do this, they should immediately resign now. I would recommend you to resign. Resign. Better word is resignation. Because if you can't do this, you have no right to appear in the exam. It's better you give your money to a poor guy and he will study. He will study. If you can't do this adjustment at this stage, at the end of the course, you should donate your whole examination fees to a poor guy so that he can study. Now, an item of plant had a fair value of 2.6 million above. That means upward, above carrying amount. This is upward fair value adjustment. Okay. So the remaining life of the plant at the date of acquisition was 3 years. 3 years. This is for excess depreciation. Depreciation is charged to cost of sales. Yes. How we'll do it? You remember this C is equal to A minus L. C is equal to A minus L. Okay. So we need to calculate net assets. Net assets is C. Net asset is C. So when assets will go up 2600, net asset will also go up. So this will be added. This will be added in the net asset packet. This will be added in the net asset packet. This is the first thing. This is the first thing. Okay. This is the first thing. You need to add it in the net asset packet. Okay. One more thing, you need to calculate excess depreciation. You need to calculate excess depreciation. How you do it? Listen. 2600 is the revaluation amount divided by 3 years. And see, now hold. When you divide by 3 years, in the denominator, you are writing years. So you will get per annum answer. You will get per annum 12 months answers. But see, there is a 9-month gap between acquisition. You are making income statement. You are adding subsidiary companies just for 9 months. You are adding subsidiary companies for 9 months. And there is a 9-month gap between acquisition date and the reporting date. So you need to apportion the excess depreciation as well. And you always do. You always do in your past papers. Come on, do it. Tell me how much? 650. 650 is your excess depreciation. 650 is your excess depreciation. 650 is your excess depreciation. Okay, now let me tell you the treatment of this excess. This is not a SOFP question. For this excess depreciation point of view, this is not SOFP, this is income statement question. Let me tell you the treatment. Upward fair value adjustment excess depreciation. Listen very slowly. Upward fair value adjustment excess depreciation is added in consolidated cost of sales, and it is deducted from NCI working. It is deducted from income statement NCI working. Okay. Because this asset belongs to S company. This plant belongs to S company. Okay. I'm sure you know this. Now, one more thing, silver company has a contingent liability. Very famous adjustment. If you guys remember, whenever I teach consolidation, in the last classes of consolidation, I discuss some issues of consolidation. I always discuss this issue. You know what is this issue? This is P company. Just giving you a recap. This is P company and this is S company. Let us say at the date of takeover, when P company was acquiring S company, there is a contingent liability. There is a contingent liability in the books of S company. There is a contingent liability disclosure in the books of S company. Okay. So in the individual books, it's fine. In the individual books, this disclosure is fine. But for the purpose of consolidation, it is the requirement of IFRS 3 that S company will calculate the fair value and S company will give birth. S company will recognize this liability. So this will be treated as a fair value adjustment liability. This will be treated as a fair value adjustment liability. Relax. You have heard about fair value adjustments assets, but yes, sometimes examiner gives fair value adjustment liability. Now first read this line. First read it. Silver company had a contingent liability which gold company estimated to have a fair value of 850. Wait, C is equal to A minus L. And now when you are going to book a liability by 850, so when liability goes up, net assets goes down. When liability goes up, net assets goes down. When liability, see the equation, C is equal to A minus L. When liability goes up, net assets goes down. Yes, contingent liability will decrease the net asset packet. Okay. And there is nothing to do with the income statement. This has not charged at 30th September X2. That means this will only affect the goodwill working. This will only affect the goodwill working, Now wait, let me show you the net asset packet. See, in the net asset packet, there is a fair value adjustment plant. How much? I think it was 2600. And there is a contingent consideration, contingent liability. It was 850. Okay. So this is your basically net asset packet. How much is this? Can you tell me the net asset packet? Okay, it's 301. Sorry, somebody told me 76230. You got it? Okay, so now let me walk through the question, giving you guys 30 seconds or a minute to read. If you want to read, you can read adjustment number 2. Take your time. There are some few students, they have calculated goodwill themselves. Very good. Some students have already calculated the goodwill. Thank you. Very good. Now, note number three. I've already taught you. I don't need to even read it. Gold company's policy is to value the non-controlling interest at fair value. Yes, they say this is a full goodwill method. They say this is a full goodwill method. Full goodwill method. Okay. For this purpose, silver company share price at that date. Remember, S company share price, I have taken $3.5 in front of you, can be deemed to be representative of the fair value of the shares held by the non-controlling interest. Okay, so we have already calculated fair value of NCI using the share price of S company. Students, we did it. Now, easy peasy F3 level things coming. Sales from gold company P to S. Thank you. P to S company in the post acquisition period. That means after the takeover. There are total 9 months. After takeover, there are total 9 months. Had consistently been 600,000 per month. Come on. There are total 9 months. And how much is the per month sales? Come on, quick. There are total 9 months. How much is the per month sales? 600. So 600 times 9. 600 times 9, it's 5,400. This is the total sales. This is the total P to S sale. Let me make a sketch for you. This is the total P to S sale of 5,400. Okay, P to S sale of 5,400. And now gold company made a markup on cost of 25% on these sales. No issue. Silver company had 1.2 million at the year end, 1,200 inventory. 1,200 inventory unsold. Inventory of 1,200 is unsold at the year end. 1.2 million of these inventory at 30th September X2. Now, listen very carefully. You need to calculate unrealized profit. you need to calculate unrealized profit. My dear students, unrealized profit is calculated on unsold goods. Unrealized profit is calculated on unsold goods. Remember? Okay. So from 1200 we'll calculate. Let me teach you again with basics. Let me write. I'm writing here SCP. Many of you have done this. You know, this 1200 is the cost of S company. This 1200 is the cost of S company, but it's selling price of P company. This 1200 is the cost of S company, but selling price of P company. So I'm writing here 1200, and P companies charges markup. Markup means profit percentage on cost. Markup means profit percentage on cost. So cost is 100, profit is 25. So this will be 125. So, okay, can anybody calculate this URP? Can any 1200 divided by 125 into 25? 1200 divided by 125 into 25. So 240 is the URP. 240 is the URP. 240 is the URP. This is we teach in F3 paper, basic fundamentals paper, we teach this. Now, wait. This is not a SOFP question. This is income statement question. Write on your hand here. This is not an SOFP question. This is income statement question. Please write here on your hands. Now, listen. My dear students, this is P2S sale, and the P2S sales is 5400. So in income statement, there are 5 steps or 6 steps of P2S sale. In income statement, how many steps are there? 5 or 6? In income statement, in terms of P2S, how many steps are there? 5 or 6? 5 or 6? You guys are corrupt people, I'm sure. I should make a video against you. Wait one day. Tomorrow I'll make a video for you guys in the social media. I will tell your reality to whole world. P2S sale, how many steps in income statement? P2S, not S2P. Just 2 steps. Just 2 lines teachers write. 2 steps. The first step, the amount of transaction, this 5400 will be deducted from sales and cost of sales, consolidated sales and cost of sales. First step. And the second step is URP. URP of 240 will be added in consolidated cost of sales. That's it. If you guys are thinking 3 step like sales, cost of sales separately, then it's okay. But normally when we write on the board, we write 2 steps. 2 steps for P2S and 3 steps for S2P. Sale of inventory, right? So this sales of 5400, this sales, I got it. I got your point. Don't worry. So sales of 5400 will be deducted from consolidated sales and cost of sales, first step. And this URP of 240 will be added in consolidated cost of sales. Now, point number 5. Point number 5. Just take a break. Enjoy learn the class. Learn something new. Learn something new. Revise the concepts. What you did in your normal class. You remember the associate? How to record associate? Tell me how to record associate in income statement. How to record associate in income statement. Giving you 30 seconds. Yes, one line adjustment. And what is associate share of profit? Associate share of profit. Associate share of profit. Remember, associate share of profit. And what is the formula? Let me write. Associate share of profit. A company PAT multiply by the holding percentage of a company. That's it. A company's PAT multiply by the holding percentage of a company. That's it. And you know, I say that PAT is a big box. 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 And dividends are always included in PAT. Dividends are always included in the PAT. Remember this concept? So now, wait. Gold companies, this is a dodgy thing. Gold companies investment income is a dividend received from its investment in 40% owned associate, which it has held for several years. The associate made a profit. Profit means profit after tax. Profit means profit after tax of 3 million for the year ended 30th September X2. For the year ended 30th September X2. Now, we own this associate for the whole year, not 9 months. Listen. We own this associate for the whole year, not 9 months. So no need to apportion this thing. No need to apportion. Please, student, you can see since many years it is written. So you just want to do, just think 3 million is the profit after tax. 3 million times 40%, that is 1200. Just book it in the consolidated income statement in one line. And now everything is already here. All effects you have taken, even the dividend effect, you already took it. Listen, in profit after tax, dividend is also included. In the profit after tax, dividends are also included. Dividends are also included. So when you multiply 3 million times 40%, you have already booked the dividend. So now no need to write the dividends. Now no need to write the dividends of associate company. Listen. So what you will do, you will cancel out this investment income. You will cancel out this investment income in the consolidated SOCI, and instead of this you will write one line associate share of profit, and then that associate share of profit includes everything. That associate share of profit includes everything. Okay. Yes, we have to eliminate this 800 amount from investment income. We have to eliminate this 800. You have to cancel out, just remove it. And instead of this, just write associate share of profit. After GP, after gross profit, we'll add associate share of profit. Now, the last question is IFRS 9. IFRS 9, this has nothing to do with the consolidation, please. This has nothing to do with the consolidation. This is a normal IFRS 9 baby adjustment, baby adjustment. Sometimes I teach 5 to 6 questions when I teach this standard of convertible loan note. Straight away, we teach many questions, and in the final accounts, you have done it many times. See, this transaction is related to gold company. This is the key point. This note number 6 is related to gold company. So it has nothing to do with the subsidiary. This is parent company's separate transaction. So this has nothing to do with S company. So when it has nothing to do with S company, that's why this transaction won't affect NCI. This transaction won't affect NCI. Okay. So I'm sure you remember the day when we issue convertible loan note, we separate debt and equity. Yes, we'll take full year effect. Very good. Because the loan notes are issued on the first day of parent company's accounting period. The loan notes are issued on the first day of accounting period. So we need to take we need to start from 1st October X1. We need to start from 1st of October X1. That means we need to take full year's effect. Okay, and now we need to separate debt and equity. How to separate debt and equity? Can anybody tell me? Yes, find out the cash flows, all possible cash flows. So see, $100,000, $100,000 loan notes. So 100,000 times multiplied. See, 100,000 units, 100,000 loan notes, and each loan note is $100. So the total amount will be 100,000 multiplied by 100. And if you remove three zeros, the number is 10,000. Okay. As we are going without three zeros, so the number will be 10,000. You are not getting, wait. 100,000 are the number of loan notes, and each loan note is $100. So 100,000 multiplied by 100 is the actual amount of loan. Okay. And we are going without three zeros, so it will be $10,000. Now, what's the physical interest rate? What's the physical interest? 6%. So 10,000 times 6%, 600. 600 is the physical interest. 600 is the physical interest. Okay. 600 is the physical interest. Now, how many years are there? 5 years. 5 years. So you need to give 5 years straight away. You need to give 5 years straight away interest, physical interest, and in the end you need to give principal. In the end you need to repay principal. Okay. So 5 equal interest payments. 5 equal interest payment of 600 each. 500 equal interest payment of 600 each. And then in the end, you need to pay 10,000. You need to pay 10,000. Now, a biggest dodge, and I beg you, if you don't know this, it's time to cry. Let's cry together. You do discounting using market rate. See, this is the market rate. This is the market rate. Never use coupon rate for discounting. So let's cut this. This is irrelevant. They are trying to make you fool. Examiner is trying to make you fool. Never ever do discounting using coupon rate. We use discount factor of market interest rate. All the liabilities and all the assets in the balance sheet are discounting using market rate. Okay. Now, listen students, as the interest is 5 equal payments of interest, that's why we'll use annuity factor. We'll use this annuity factor for interest discounting, and we'll use this 0.681 for the 10,000 discounting. We'll use this 0.681 for the 10,000 discounting. Okay, right? Are you getting? Can anybody calculate the liability element for me? Can anybody calculate the liability element for me? Very good, very good. Many students calculated it. Very good. Wait, let me tell you. Present values will be 600 multiplied by 3.993. Okay. And then 10,000 multiplied by, what is this? 0.681. Okay. So if you add these two, it will be 925, sorry. 9205, sorry. Okay, this is your liability element. Now, as a student, you may ask, sir, why are you not calculating the debt and equity split? We are not doing balance sheet. We are not doing SOFP. So just you need to calculate the liability element. And now, I hope you remember, you need to calculate interest expense for the whole year as well. You need to calculate the finance cost or interest expense for the whole year. I told you many times this dialogue. Whatever interest rate is used for discounting, the same interest rate we use for unwinding. So we should use 8%. We should use 8% to calculate interest expense. because we used 8% for discounting. How much is this? So 736 is your actual finance cost. 736 is your actual finance cost, which you should book, but you already booked something less, already booked in PNL, less, already booked in PNL. Wait, let me show you the question. This is the question. See, this is the question. It is written, charged gold company has recorded the loan note as a liability at par value. See, this is their mistake, and charge the annual 6% interest to finance cost. That means 600 they have already booked. 600 they have already booked out of 736. 600 they have already booked. 600 they have already booked. Okay, so now the remaining 136 we need to book. Remaining 136 we need to book. This is the only thing we have to do for this. For this whole convertible loan note, only 136 is the relevant number. And yes, this 136 will be added in finance cost. 136 will be added in finance cost. Okay. This is your annuity factor, student. This is your annuity factor, AF. Okay. Because annuity is 5. These are 5 cash flows, 5 equal cash flows. And in your basic F2 paper, you studied annuities. When you have same cash flows, and equal interval of time, such series of payments are called annuities. And to calculate the present value of annuities, what you do, single annuity multiply by annuity factor. You don't need to calculate equity element, my dear student. It's a balance sheet. It's not a balance sheet question. It's just income statement question. And you just need to deal with the interest expense. Okay. So my dear student, just don't do irrelevant things. Students, this is also a very, very important exam technique, that don't do extra thing in the exam. Okay, so nothing to do with NCI in this part. It's all parent company. Now we have discussed all adjustments. Now I'm going to solve this question. See the requirement there at 30th September X2, no impairment up to goodwill is required. Thank God, no impairment is there. Profits are accrued evenly throughout the year unless otherwise stated. Okay, you need to apportion all things to 9/12. You need to apportion all things to 9/12. Students, can you see the requirement? The first requirement is goodwill, and the second requirement, you need to prepare consolidated statement of profit and loss. Yes, impairment should be recorded at operating expenses, but in this question, it's goodwill impairment is not given. Now, students, I'm going to take a risk. Right now, I'm teaching with my iPad. This device. Okay. But it's my personal wish to solve this question on Excel. It's my personal wish. But to solve it on Excel, I need to shift to my laptop again. But last time in my F6 revision day, when I shifted to this, there is some problem in my laptop. Sometime it's a luck, but still, let me try to shift on my laptop. And if I will be easily shifted to laptop, then I can solve, because the speed of laptop is little bit slow, but still I managed to fix it up to the maximum extent. So now I'm going to shift it, I'm going to shift myself to this laptop, okay, and to the Excel. But you must remember all these things. First of all, wait. If you don't have question, please take the pictures. If you don't have questions, please take the picture of question. Please take the picture of question. If you don't have this question, please take the picture. If you don't have question, please take the picture of question. Otherwise, you will have problem. Okay, one more picture. Okay, so now I am on my laptop. I am on my laptop. Wait. Okay. It will go a little slow. Don't worry about it. Don't worry about it. Okay, right. So my dear students, first of all, we are going to calculate goodwill. First of all, we are going to calculate goodwill. Okay, so for goodwill, you need to calculate the consideration. Let me write first things in the bracket. Okay, your consideration was 14,400 shares you acquired times 2.4 times 2.4 per share you paid, 2.42 per share you paid. Okay, so this is the original amount times, for discounting you need to multiply it with 0.9091. okay, bracket close. This is the working I'm showing. Let me solve it here. Let me solve it here. Equals 14,400 times, wait, times 2.42 times 0.9091. See this. This is your deferred consideration. Okay. And now let me write the shares consideration. Shares consideration is again 14,400 shares where we acquired times 3/5 times 3 divided by 5. And what was the value of our one chocolate? Our one chocolate cost $8. Our one chocolate cost $8. Okay, multiply by 8.4, sorry. Our one chocolate cost 8.4. It's 8, sorry. In the question, it is written 8. Yes. Come on, come here. Equals 14,400 times 3 divided by 5 times 8. 69120. 69120. 69120. Okay, so let's, now the next thing is fair value of NCI at acquisition. Remember how many shares NCI had? NCI had 1,600 shares. NCI had 1,600 shares times 3.5. I think 3.5 per share. 3.5 is the value per share. So let's do it here. Equals 1,600 times 3.5. Okay, now let's add these three. These three we need to add. With these three we need to add. Okay, so this will be 106,400. Okay, guys, it's simple. I've already taught you. I'm just doing a formality. Students, my dear students, I'm just doing a formality to do it. Now, less fair value of net assets of S company. Less fair value of net assets of S company. Ordinary share capital at the date of acquisition is 16,000. Ordinary share capital was 16,000. Now, for retained earning, remember the retained earning. Let me solve it directly. For retained earning, you will write how much was your opening retained earning? I think it was 56,000. It was 56,000, or simple 56,000 plus 99. What was the profit for the year? 9920. The profit was 9920. Yes, 9920 times 3 divided by 12. Okay, 58480. 58480, right? Okay, now what was the fair value adjustment plant? Fair value adjustment plant was just 2600. And contingent liability, remember, when liability goes up, net asset goes down. Liability goes up, net asset goes down, so it will go as a negative number, 850. Okay, now let me write here the fair value of net assets. Let's sum it. Wait, this is the whole packet. See, this is the whole packet, student. This is the whole packet. This is the whole packet which we need to net off. Okay, now how to calculate goodwill? See, this less, sorry, this is your goodwill. This is your goodwill. Did you get it? Did you get it? How did we calculate goodwill? I think you can understand, because we spent a lot of time on it. We spent a lot of time on discussing the question. Please reply, students. All of you, please write a single message. If you understood this, please write it here. Okay, thank you. What is the voice issue? I think voice is perfect. Voice is perfect. Is there any voice issue? No issue. I think the voice is okay. Now let me do the income statement. But I always say, whenever I teach income statement, consolidated income statement, I say students to first prepare your mind. First prepare your mind. Listen to me. Income statement is always for the year. Income statement is always for the year. So parent company is for the year, whole year. It's mine company, and subsidiary company I need to do 9/12. For subsidiary company, I need to do 9/12. Okay, all data of subsidiary company I should do 9/12. Okay, right? One thing. Second thing we need to adjust is intercompany sales. There is intercompany sales P2S. There is intercompany sales P2S. There is intercompany sales P2S. P2S intercompany sales. Okay, so I already taught you the two steps. P2S sales, 5,400 sales and cost of sales to be knocked off, and URP will be added in consolidated cost of sales. My dear student, I have already taught you. Please don't say no now. Then, you know, there was an upward fair value adjustment. Yes, we all know that upward fair value adjustment never comes in the income statement, but yes, the excess depreciation of the upward fair value adjustment always goes in consolidated income statement. How? It will be added in consolidated cost of sales, and it will be deducted from NCI working. Don't worry, I'll show you. Okay, right? And few more things. Investment for associate, you need to write associate share of profit. For associate, you need to write associate share of profit. And one basic thing which I've already told you, parent company complete data we'll write, and S company we'll write 9 upon 12. Parent company complete data we'll write, and S company data we'll write 9 upon 12. Okay. Now one more thing, finance cost, please be careful. Finance cost, yes, finance cost, unwinding of discount of deferred consideration, unwinding of discount of deferred consideration, we need to take impact, yes. And the second thing we need to take impact is the convertible loan note. The convertible loan note extra 136. The convertible loan note extra 136, 136. Okay. That also we need to take the impact. Don't worry, I'll teach you. Now, let's start. Let's start, please. I've already written the headings so that we don't waste times on that things. Okay. So first of all, what's the revenue? Let me write in the bracket. The revenue for parent company is how much? 103360. 10360 plus subsidiary company, we need to divide it by 9 upon 12. 9 upon 12. Okay. So it will be how much? 60800 times 9 upon 12. 60800 times 9 divided by 12. And then you need to subtract remember, 5400 intercompany sales, you need to subtract 5400. Okay. So this is all you need. This is all you need to do. That's all you need to do. Wait. Okay. So now what will be the number? Let me write the number. Equals 103360 plus 60800, wait, times 9 by 12, bracket close. Then we'll write, wait. Then we'll write less 5400. See, this is the formula. 143560. 143560. Okay. Now the next thing is cost of sales. Next thing is cost of sales. What is the cost of sales? Wait, cost of sales for parent company is 81920. 81920. Then plus subsidiary company 9 months data. Subsidiary company 41600. 41600 times 9 divided by 12, bracket close. Okay. Then first of all, you need to subtract 5400, same 5400. Then you need to add URP. That was 240. And then you need to add excess depreciation, that was 650. You need to add excess depreciation, that was 650. Remember this, easily check it. So it will be equal equal 81920 plus bracket open 41600 times 9 upon 12, bracket close, less 5400, add 240, add sorry, what happened? Oh, sorry, let me do it again. Equal 81920 plus bracket open How much? 41,600 times 9 divided by 12, bracket close, less 5,400, then add 240, then add 650, that was excess depreciation. Yes. Okay, so this is 112077, 112077, 112077, 112077. Can you please confirm? Can you please confirm, anybody, that this number is correct? 5,400, 5,400, and 240 and 650. 8190, then 41. Oh, sorry. 41,600. We need to multiply by 9 upon 12. Yes. 108610. 108. I forgot to write the multiply sign. See, I forgot to write the multiply sign. Okay. Now this is the cost of sales. Now what is the GP, gross profit? This less this. This is 34950 is your gross profit. Now how to calculate distribution cost? Simple. Directly I'm doing it here. Distribution cost, for distribution cost, parent company's full amount, How much is the parent company's amount? Parent company's amount is 2560. It's 2560. And subsidiary company's amount is how much? It's 2980 times 9 upon 12. 2980 times 9 divided by 12, bracket close. See this. This is the distribution cost. Now what is the admin cost? Admin cost is 6080 plus the subsidiaries company's amount. How much is this? It's 3740 times 9 divided by 12, bracket close. Okay. Now associate share of profit. Hope you remember. For associate share of profit, it was 3,000,000, 3,000 times how much? 40%. 3,000 times 40%. Okay. Let me do it here. 3,000 was the profit after tax times 0.4 times 0.4. 3,000 times 0.4. Associate share of profit is 1,200. Remember? Okay. Associate share of profit is 1,200. Now, technical thing is finance cost. Please look at here. Finance cost. How much is the finance cost? Existing finance cost of parent company. How much is the existing finance cost of parent company? Let me check the question. How much was the existing finance cost of parent company? How much was the existing finance cost of parent company? It was 672. Okay, 672 was the existing finance cost. Then there was some finance cost related to unwinding of discount. It was 2376. Okay, and there was 136 for convertible loan notes. Repeat. 672 existing finance cost given in the parent company's income statement. Then 2376. Remember, 2376 was the unwinding of discount of deferred consideration, and 136 is the convertible loan note. 136 is the convertible loan note. Okay, let me write here. Sorry, it will be 672 equals 672 plus 672 plus 2376 plus 136. Okay, now we need to calculate profit before tax. How? This is GP less this less, sorry, this less, sorry, add this, because associate share of profit we need to add, and then you need to deduct this finance cost. 19286, 19286, 19286, 19286. Okay. Now, what is the income tax expense? Simple. Parent company's full year tax is how much? 4480. Parent company's full year tax is 4480. Parent company's full year tax is 4480. So 4480, and subsidiary companies only 9 months. Subsidiary company only 9 months. How much is this? 2560 times 9 upon 12. 2560 times 9 divided by 12. Okay, please have a look. Okay, now profit for the year. PBT less tax. Okay, so that's your profit for the year. Now what you have to do, you have added income statement like as if you own everything, but in reality you own only 90%. But in reality you own, my dear student, you own only 90%. So now finally in the end you need to calculate the income statement NCI. Finally in the end you need to calculate income statement NCI. Okay, giving you just 1 minute just to relax, and then I'll calculate NCI as well. Now, how to calculate income statement NCI? Look at here. As income statement is calculated for the year, as income statement is always calculated for the year, that's why NCI will also be calculated for the year. Now wait. NCI is calculated from S company's profit after tax. NCI is calculated from S company's profit after tax. Look at here, students. So S company is only with us for 9 months. In this year, S company was with us for 9 months. So in order to calculate NCI, we need to apportion S company's profit after tax. Okay, let me show you the working. See, Silver's company's profit after tax, this will be 9. I think profit after tax is 9920. 9920 times 9 upon 12. Okay, now few things let's revise. Few things put you in your dictionary. Excess depreciation of fair value adjustment affects the NCI, yes. And if there is S2P sale of inventory, then you adjust the URP here. And if there is full goodwill method impairment of full goodwill method, then you need to affect NCI. These are the famous things. These are the very famous things which affects the NCI of income statement. So in this question, yes, there is an excess depreciation of upward fair value adjustment. There is depreciation of upward fair value adjustment, so we need to deduct here. But there is no S2P sale. In this question, so ignore it. There is no impairment of goodwill. There is no impairment of goodwill of full goodwill method. So ignore it. So only one thing. So let's calculate the final profit and now multiply it by 10%. Multiply it by 10% at the rate 10%. Wait. Yes. So how much will be 679? This will be 679. Okay. This will be 679. This will be 679. Okay. 6790 time 10% is 679. Right. So now this is 679. Okay. Let me go to the question. Now the three famous line, remember in the income statement question, we make these three famous lines. Listen, profits attributable to equity owners of the P company. See this. First of all, write the total profit. What's the total profit? The total profit is 12886. How much is the NCI? How much was the NCI? It was 670. NCI was 679. NCI was 679. Can you tell me how much is the profit? See, this total profit less this number, you will get profits attributable. You will get profit attributable. You will get profit attributable. Okay. So let me show you the big picture. Wait. Yes. This is your consolidated income statement. This is your consolidated income statement. Now, as the time was already up, I didn't show you the workings. It didn't show you the workings in Excel for convertible loan note and P2S sale. That's very easy. But I showed you in my iPad with pen. Okay. So that was also not very difficult. This whole Excel work is very easy. This whole Excel work is easy. It's not difficult. It's just about practice. But yes, I would recommend you one thing. Listen, students, it is written in the examiner report. I know you guys don't read examiner report because you think it's rubbish. It's not rubbish. It's very useful thing. Examiner has written those students who don't practice on software, those students who don't practice the last 40 marks on software, they have issues in the exams. They normally fail. See, your whole time will be lost. Your money will be lost. Your whole motivation will be lost. So it's better you practice. Okay. It's better you solve the mock exams. Today I gave you one email ID. Just for the registered students, I gave you one email ID. Try to send me your ratio analysis questions and answers. Question in that email, right? Attach the question as well as the solutions. Okay, your own written solutions. So I'll mark them. I'll give you the feedback. on it. Okay, right? Did you understand it? I'll send you this Excel file. Don't worry. I'll send you the Excel file and that sheet as well. So as these are last days, try to save each and every second now. Still you have 10 days, still you have 10 to 11 days. Still you can work, you can do a very good revision. Try to believe in yourself. Okay. Try to believe in yourself that you can do it. Okay. Try to make summaries, try to revise with summaries, with the help of summaries. In the ending days, it's not time to watch complete lectures now. Yes, you can watch the revision days, you can watch the past papers, but this is not the time to watch regular IAS and the regular lectures. It's not the time. Okay. And I give you one more tip. In the last 2 3 days, when you have just 2 3 days left, so if you want to do a quick revision, so you can solve your kit orally. You can solve past papers orally. What do you mean by orally? Check the question, close your eyes, think the solution, and then you can check the solution. Quick. In this way you can revise many things. When I was a student, I used to apply this technique. Okay. So it's time to say yes. I will upload on YouTube this I will upload this class on YouTube. Don't worry. One more thing. I have uploaded already four classes in English language. Four revision days are already there in English language. Four revision days are already there in English language on YouTube. So if anybody of you wants to revise, wants to check those revision days, they are very good. They are very helpful. Even I have given many basic lectures there. Okay. So it's yes, cash flow. Cash flow is also part of your course. It's not much in fashion, but yes, it's part of the course. And few students told me in last 2 3 attempts that they got the question, they got at least 10 marks. So yes, give some time to cash flow. At least you must have knowledge, right? Okay. So take care. Bye bye. Allah Hafiz.